Hello, welcome to Any Answers Answered for October 2020. Hopefully everybody is keeping well, keeping out of trouble. And as ever, Tim and I have had a look through the pages of Any Answers on accountingWEB and picked out a couple of questions that we would like to have a look at today. The first of the questions is to do with a business starting up and how we calculate exactly what goes into those opening year calculations. The question comes from MC1 and is as follows. We have a brand new sole trader who has an accounting period 1st of September 18 through to 31st of March 2020, a 19-month period. The question is, so should the profits be apportioned as 1819 from the start, 1st of September through to the 5th of April, and then in the second year, 2019-20, from the 1st of April through to the 31st of March, a 12-month period, thus giving 5 days overlap profit. Tim, over to you.
Well, thanks, Giles. And the first point to make is that contrary to one or two of the comments in this particular Any Answers thread, there is no requirement for a sole trader or partnership to draw accounts for a period that is no more than 18 months. And this is quite a common misconception. I think in company law, there is a legal requirement for accounts to be drawn up to a maximum of 18 months. But as far as unincorporated businesses are concerned, there is no such 18-month requirement. One of the posters says, I'm not convinced your 19-month accounts are valid as they're more than 18 months. But actually, that's not an issue. They are valid. What the income tax legislation provides is that a basis period cannot be for longer than 18 months. And if either here as on a commencement or on a change of accounting date, you have an accounting period of more than 18 months, that is a valid accounting period, but the legislation then prescribes how we break that down into basis periods. And the original poster is correct that the basis period for the first tax year will be the period 1st of September 18, the commencement date, through to 5th April 19. So that is straightforward enough. And then for the second year, in this case, it'll be the 12 months to the accounting date in that second year, and the accounting date 31st of March. So it'll be from 1st April to 31st of March 20. Now, those two periods overlap by 5 days. And technically, we do have 5 days of overlap, and you would carry forward the 5 days overlap because profits in those 5 days are being taxed both in the first tax year and in the second tax year. And eventually, on a later change of accounting date or on cessation, those overlap profits would be used. However, HMRC have long recognised that creating and carrying forward overlap for the 5-day period from 1st April to 5th April is just a bit of a pain, and in most cases, not worth the hassle. And so, as the original poster and some of the posters in the thread make clear, the revenue do accept that we can treat the 31st of March as though it was the 5th April. And that applies both on a change of accounting date. If you change accounting date from, say, 31st December to the 31st of March, then you don't have to carry forward the remaining 5 days overlap. You can treat it as 5th April and use up all of the overlap on that change of accounting date. But here on cessation, we could indeed have drawn the accounts to the 31st of March 19 rather than 20, but treated that as a basis period to 5th April, provided, and this is set out, by the way, in the guidance that the Revenue have published in HS 222. So that's what to look up, HS 222, if you want confirmation of this. The Revenue will treat the 31st of March or the 1st, 2nd, 3rd, or 4th of April as 5th of April. And as long as the profits in the 5 days in this example are taxed in the second year, then you can treat it as 5th of April and not bother with any overlap relief.
The second question we have this month is from the wonderfully named Constantly Confused, who asked a question on tapered annual allowance calculation. Now, I completely misread this the first time and thought that the question was going to be about tapering the personal allowance, and then was immediately confused when they had a salary of £200,000. I thought this can't be anything to do with that. Of course, we're talking about pensions here, and we're talking about something that is becoming more of a problem with the changes that were made to, or sorry, less of a problem, hopefully, as a result of the announcements made in the budget earlier this year to move the cutoff point from 150 up to well over 200,000. Let's go through the numbers very quickly. A client has a salary of 200,000 from an employment that started in 1819. They're paying 15,000 pension contributions through their salary. The employer is topping that up with another 5,000. So they're saying their taxable income is therefore 185. Sounds right to me. They're also making private contributions of 8,000 net, 10,000 gross, plus dividend income of 5,000. We have net income of 190,000. But Tim, after that, I get horribly confused. We have to think about threshold income, adjusted income, all sorts of things. Tell us, how much pension can this person pay and get relief on?
Well, the original poster says there are so many places above I'm not sure about, it's unreal. I've read three different ideas as to what should be included where. Well, I can understand this because the whole area of calculating the annual allowance and tapering it if your income exceeds the adjusted or the threshold income levels is horribly complicated. And without wishing to turn this into a marketing exercise, it prompted me a couple of years ago to develop an Excel spreadsheet, our pencon, pension contribution tool. And as soon as I saw this post, I put the figures in. And the good news is that I agree that in this combination of salary and contributions, the annual allowance would be £10,000, assuming that there is no unused annual allowance brought forward. And that is a big assumption. It may well be that this individual has got unused annual allowance brought forward. And so the first thing to do is to check the record and the calculations for that. But in a case like this, the adjusted income and the threshold income, and I can assume here by the way that we are looking at a 1920 calculation, not a current year 2021, because if we had the same figures for the current year, in fact, the annual allowance would not be tapered because of the increase in the adjusted and the threshold income to 240,000 and 200,000 respectively from the 1920 figures, which were 150 and 110,000 respectively. So at the level of salary we're looking at here, 200,000, the taxpayer was caught last year by the tapering of the annual allowance for pension contributions, but will not be caught in the current year. Now, I'm not going to go through the details of how you work out adjusted and threshold income, but my pencon spreadsheet invites you to input the earnings, 200,000 here, the other income, the dividends, 5,000. I then ask, is there a salary sacrifice post July 15? No, there isn't. What gross contributions has the taxpayer paid themselves? And so the 10,000 grossed up contribution goes into the calculation for the taxpayer in that box. What contributions has the employer made? 15,000 gross, and out of their salary, the employer another 5,000. There are different input figures for the employer's pension scheme. We're assuming here that these are payments into a direct contribution scheme, a money purchase scheme, rather than a defined benefit scheme. And even as I say all this, it's getting too complicated for most of us to be concerned about, I would say.
What a hugely complicated area this is, and therefore entirely reasonable to have been, as the name suggests, constantly confused, but also to check it through any answers. Well, hopefully we have given some guidance to that person and others on that point, and also on the starting up a business and the opening year rules. Do join us in a month's time for some further points from Any Answers Answered. But for this month, bye-bye.